Welcome to the Midweek Market Update, where I do a technical analysis and give you my thoughts on SPY the Qs and IWM. After that, we will be taking a brief tour through our core list of companies, and if you stick with me towards the end of today's video, I've got 3 additional trade ideas to share with you, so definitely stay tuned for that. Let's kick off today's S&P analysis as we always do with our sectors: who was leading, who was losing, and where was the weight. The XLY for the consumer discretionary sector led the pack today, and this is filtered as measured from today's open. So they were at the top of the list, up 3.18%, and down at the bottom of the barrel, we see the XLE for the energy sector up 1.05%. So just the laggard, not technically down as measured from today's open. It was, though, the only red name on the board as measured from the prior day's close. Now, we know that the XLY is a heavier weight risk on sector, so nice to see that at the top of the list, and decent to also see the XLE, the energy sector, at the bottom of the barrel. It's a lighter weight risk off sector, more D for defensive, as we say. So this distribution actually strikes me as healthy, especially as we're seeing a nice solid up day in the marketplace. Now, that's not to say we're out of the woods, but it's a step in the right direction. What about the heavier weighted sectors? Obviously, the XLK, the tech sector, is the heaviest of them all. Definitely down towards the bottom of the barrel. A little bit of relative weakness there, and we'll continue to see that on the ratio grid in just a moment, only up 1.4%. The XLF for the financial sector is the second heaviest weighted sector that we're watching, up 2.29%, and the XLV, the third heaviest weight on our lineup, yes, it is the second heaviest weight by market cap, was up 1.65%. I think the most impressive thing about the XLV is not the percentage standpoint, but what's going on from the structural perspective on the daily time frame chart. We'll get to that in just a moment, but the XLY, consumer discretionary, is up first. What do we see here from a trend and structure perspective? Certainly, 2 equal lows. This does strike me as fairly concerning. Some people think of this as, oh, perfect, double bottom, right? It's got to be moving higher here. Well, yes, in the short term, I can certainly see the case for a double bottom, especially with the daily bar closing above the neckline here. However, because these 2 lows are so precise back to back against one another, I would say that there's actually lots of stop losses stacked underneath this area. And if, I'm not saying that it will happen, but if we were to reattempt this level after a lower high, so from here to here to here, this is the current risk setup in the XLY, then this would actually break. I would not be a buyer of 152.90, 153 anymore. That strikes me as a weak level of support going forward. So watch out for that if there's a turnover in the first place. But I have to give credit where credit is due. Yeah, there certainly is a little bit of a double bottom, perhaps better illustrated on the hourly time frame chart. Here's your W, right? And we've actually closed the daily session above the neckline of that pattern. So a reasonable expectation here into the end of the week might be a little bit of lift for the back test of the head and shoulders neckline, right? That's somewhere here, 162.72, or just more neutral. I would not be outright bearish in this chart until we re-interact with roughly 153. I would at least have the expectation of neutral based on that hourly double bottom that we've just sort of looked at into the end of the week. So that's the outlook in the XLY. I would also point out that there still continues to be massive relative strength in the consumer discretionary space. Notice that your break and retest level is way down here, and we're obviously not even getting into it, whereas the SPY is literally trading at and around its break and retest level. So relative strength, decent look with the double bottom, but I would just be prepared to watch for a breakdown at 153 going forward, not another chance to buy an area of support. Next up, we've got the XLB for the materials sector. What's going on in this one? Certainly a seller shut-off candle, and that's a term coined by Peter Reznicek over at shadowtrader.net. So thank you, Peter. Credit where credit is due. Certainly, look at this nice move, shutting off all of the selling pressure that happened in those 3 days worth of trading. The next stage is obviously, can we get a move up and over the 50 SMA and this horizontal level around 76? And if so, it is upward pressure for the S&P 500. Unfortunately, we know that this is such a lightweight sector, it's not going to do a whole lot in terms of moving the needle and contributing to a massive trend day in the S&Ps themselves. So is it helpful? Yeah, but it's not going to make or break the day in the S&P 500. But I would just carry forward a slightly more bullish stance based on the actions that took place on today's session. So moving along, lightweight sector, no need to spend any more time there. XLU is technically D for defensive. This is not a good-looking chart, obviously. This is moving right back up towards the highs, all-time highs, I would point out. So being defensive, this is not really a good look for more of a risk-on indication for our marketplace. Instead, I would say we want to see the XLU actually rotate closer to 72. It looked decent on the morning's opening underneath that 75.40, but Obviously, it didn't rotate lower. Instead, it ripped to the upside. So this is still a red flag for our marketplace. I would carry this one forward and keep an eye on utilities. Really don't want to see it poking into new all-time highs here. That would not give me a feeling of confidence in terms of scouting for a bottom in the S&P 500. The XLF is up next. Financials, what's going on over here? This one is sitting right on its break and retest level. Again, just like the XLY, we've got two back-to-back lows almost to the tick at 32.50. That strikes me as now becoming a weak level. So if, I'm not saying this will happen, but if we reattempt the bottom here off of a lower high, so daily trend is still currently down, right? If we reattempt that, it would actually open up the door for lower as opposed to being another opportunity for buying this area of support. In the short term, yeah, you could look at it as the beginning of a double bottom. It's not quite as bullish as the XLY because on the hourly time frame, I think we can clearly agree that it has not closed above the neckline of this sort of double bottom pattern, which would be 33.75. So still some work to be done from the buyers. I would just maintain the expectation of neutral in this range and the possibility, very, I don't want to rely on this as being a highly probable scenario, but there might be some possibility up and over that neckline, 33.75, for some continuation to the upside, and that might start to change the daily trend, but we'll see, right? This is something that the market's got to prove it before we can even think about that as a concrete piece of evidence. Clearly, the trend is down, and I don't want to deviate from that too much. So expectation is for more balance, and if this happens, then we'll reevaluate the chart after. Next up, we've got the XLC for communications, really big relative weakness, right? We just talked about relative strength in the XLY. Well, communications is the exact opposite, right? So just to sort of outline what's going on here, in the XLY, we had the break, retest, and go, and then this pullback has brought us into somewhere in here. In the SPY, we had the break, retest, and go, and the pullback has brought us somewhere in here, whereas in the XLC, obviously we're way down here. There's your break, no retest, and go. Instead, it was lower, and now we're here. So overall, massive relative weakness in the XLC. I would not really be looking here as a opportunity for like massive upside to be had. It would only really happen if we were to get up and over this 55.32. The reason I say that is because it was five days of balance here before ultimately breaking down on Tuesday's session. Yesterday, we've just barely experienced a look below and fail of this overall range, right? So look below and fail. I would not be willing to target the top end of the range for all of the reasons I've just discussed on a relative weakness perspective. The only thing I would look for in the XLC is maybe it's a smaller look below and fail on this range, and we'll reevaluate when and if we can get to 55.32, but certainly not looking at 57 just yet. So into the end of the week, maybe it's a slight bullish indication for the marketplace here, bouncing off the bottom end of the daily range, look below and fail on the smaller range. But just bear in mind, again, massive relative weakness in your XLC. Next up, we've got the XLI Industrials, as we infamously say, 7% of our S&P 500. This one's got to be more neutral, again, going sideways in this range. We've got some equal lows. They are sort of slightly descending there, but nonetheless, not nearly as bullish as the XLY. Just like the XLF, it did not close above its neckline of the double bottom pattern. Again, on the hourly time frame, it might be easier to see here, so we can all agree there's your W. We've kind of closed right at the neckline of the double bottom, but certainly not, it doesn't really strike me as a massive bullish takeaway for the marketplace. And even so, only 7%. If this were to break out above, again, it's going to help out, be a tailwind, push higher for the S&P 500, but it's not going to make or break the day. I would think that a reasonable expectation into the end of the week is neutral, or maybe slightly, very slightly bullish if we take out that 95, let's call it 94.65-ish area. Next up, we've got the real estate sector. What's going on in the real estate sector? So very similar look to most things we've seen so far. Sure, on the smaller time frame, let's go to the hourly. It is a double bottom with a close above the neckline. I will give credit where credit is due, but I would not be bullish in the real estate sector. I still think that this is probably going to stuff on the back test of 43.11 just because we have our head and shoulders neckline boom. There it is. Obviously, our daily downtrend is intact. We're doing something like this. Even if we do rally into it, I'm just personally not of the belief that this really gets going in the upward direction. And obviously, even if it were to do that, it's still such a lightweight sector. It's not going to make or break the day in the S&P 500. Just as a complete sidebar here, as someone who keeps tabs on the local real estate market for investment properties, I'm seeing, many more listings than what we experienced earlier on in the year. I'm seeing multiple price decreases on the same property. I'm seeing listings last on the market longer than they were currently. So I think that the demand for property is certainly drying up a little bit, and obviously higher interest rates have something to do with that. But overall, that's obviously not a bullish look for your real estate sector. And again, complete sidebar, completely localized to my own personal market here, but I would imagine that it's the broader trend across the United States. I've seen headlines kind of from all over the place about supply kind of increasing anyway. So next up, XLV, what's going on in the healthcare space? Really, really important chart here. So here's the monthly range. We've talked about the importance of 125 until we're blue in the face. We've talked about the number over and over and over again. And look at what happened on today's session. We actually reversed off of it, contrary to my beliefs early on in the pre-market live stream, right? We were thinking, okay, inverted hammer, failed to get up and over these highs even. The buyers completely failed to hold their close prices towards the highs on Tuesday. Weak close, we were opening down towards the lows of the Tuesday session. I was of the belief that, okay, kind of gearing up and watching for the breakdown of 125. It never came. Instead, we rallied all day and closed up towards the top of this now, what is that, 6-7 day range, which is just incredible. So overall, it's kind of do or die time for the buyers, not the sellers, the buyers. Obviously, the daily trend is to the downside. So the sellers do have the upper hand here, but if the buyers are going to make a stand, it's got to come sooner rather than later, up and over 127. Think about what that would do. Anyone who is looking at this as a bear flag, trying to play the breakdown of that monthly low that we just identified, they're dead wrong. Like anyone who is shorting in this general zone, I'm sure has some stop loss somewhere in this area. So again, think the opposite of what we discussed in the XLY. If we were to breach this to the upside, not only do we go on a stop run, but anyone who just kind of wants to hang on to the short position is suddenly in the hot seat, right? They're thinking, okay, how much longer am I going to hold on to this? Am I going to hold on to this? Am I going to bail on it? So 127.16, it's kind of do or die time for the buyers. They need to make it happen here. If it doesn't happen and we roll back over into range, that to me would just be, I don't want to say proof that the buyers are not going to take that stand, but you know, it was ripe for the sellers to do it today, to take it down, and it didn't happen. So it's think about it in the opposite sense, I suppose. The sellers did not show up and do their job today. So in their absence, it's up to the buyers to kind of prove them wrong, right? And as we pointed out, the sellers still have the upper hand. We're in a daily downtrend, so it's on the buyers right now to prove themselves. So hopefully that wasn't too much of a sidebar, and hopefully that made sense in terms of thinking about the timing of something like this, but really, really important chart to be watching into the end of the week because as we know, second heaviest weighted component of the S&P 500. So if all of this sounds like jibber jabber and you're not sure how to use it in your actual trading, let me try to break it down one last time. Here's a range. If we poke out of the top, that to me would be bullish pressure for the S&P 500. At minimum, you should not be looking for massive rollover shorts in the S&Ps if the XLV breaks out up and over 127. Instead, I would say you should probably start to favor any intraday bullish setups as and if this is breaking out of 127.16. Whenever we're dealing with daily balance ranges, we're typically looking to double that range, and that takes us just north of 129. So that's the upside. What about if we do something like this? We open and fizzle back in. I would be neutral. I would not be looking for the long, and I would be looking for the breakdown of 125. When and if the breakdown of 125 in the XLV comes, that's where it's like, okay, in the SPY itself, you're probably looking for the downside trade then. Okay, so hopefully that was useful in terms of walking through that and providing a little bit more clarity in terms of concrete takeaways for trading. So XLP, what's going on in the consumer staples space? You can see here's a range. Here's kind of the midpoint of that range. We're closer to the midpoint. This strikes me as fine. Technically, this is D for defensive, so we don't want to see it leading the charge up and over these highs, which it's not. And we also obviously know that downward pressure is still downward pressure for the market, so we didn't really want to see it break down underneath 71.71. So far, so good. No major red flags here in the XLP, playing nicely in the midpoint of the range. Next up, we've got the XLK, the heaviest weighted component of the S&P 500. What's going on over on this chart? I would say that this is actually more in the neutral category. This is not as bullish as the XLV. And the reason being, honestly, is here's your break and retest level, right? The XLV, sure, you could make the comparison that it's, on a relative basis at 125, quite literally the same number. But anyways, on a relative structural basis, right, kind of in here. But think about where this is in terms of its critical level, right? This 133, let's call it 134 just for round number's sake, was the critical level, the break and retest level. We've closed on it after spending some time underneath in the past 4 trading days. So it's not quite as bullish in the sense that it didn't rotate up towards the quote-unquote neckline of any pseudo double bottom that was kind of going to form here. If we take a look at the hourly time frame chart, again, this is kind of the W that we've been looking at in many other charts. We're not there, right? Instead, we're just kind of flirting around and getting stuck at that 134 daily pivot level from in here. So I've got to be a little bit more neutral in this one. I can't be like looking for any sort of move higher. Obviously, again, the daily downtrend is still firmly in effect. Even if we do rally into like 139, there's a possibility of lower high. I'm not denying that, but you can see how this is obviously different from what we've seen so far in some other sectors. It's flirting with that critical area, and we've really closed right on it. So I've got to give maybe a slight edge to the sellers, giving credit where credit is due, who were actually able to get and push prices underneath the daily pivot, whereas in most of the other sectors that are important, we've seen something where, okay, we're still hanging out above that critical level. So neutral to slight edge to the sellers here in the XLK, and being the heaviest weighted component, that doesn't really fare too well for like overall massive bullish moves in the S&P 500. So there were some bullish structures that we've looked at, but I just don't want to sound overly bullish here because, again, think about the daily trends. It's still firmly down. Okay, so short-term dead cat bounce can happen, but the daily downtrend is intact. Okay, so that's what I would say about this. There are some other bullish data points that we'll look at in just a moment, and we'll get to those. But bear with me as we round out the sectors and then the ratio grid. So XLE, what's going on here? Actually a decent look. We know that this is D for defensive. No, that's not D for decent, although it is decent. It's D for defensive, so we really don't want to see this rallying up towards the highs, making new highs. We knew that this pattern, the sort of break and retest, was starting to hold in the XLE, but on today's session, we actually gapped down underneath that level. We rallied to close some of the gap, but there was no acceptance back above 78.41. So that does strike me as a decent look for the S&P 500. We do want to see this continue to deteriorate and just hang out sideways in here. We don't want to see it back above that 78.41. So actually a step in the right direction in terms of risk on, risk off. Speaking of that, let's take a look at our ratio grid. If you don't know what this screen is, top right-hand corner's got you covered in terms of a brief tutorial on setting it up. But let's talk about the takeaways here for today's session. XLK, XLV, XLY, XLF are the risk on sectors. These are the big four. That's why they take up the most real estate. So the XLK, unfortunately, is clearly pointing to the downside. That is not a risk on indication. And being the heaviest weighted component, this is really the thorn in the side of any upside in the S&P currently, because if we look at everything else in the upper quadrant here in the top four, XLV pointing higher. Granted, still yes, underneath the 50 SMA, that's the gold line, but pointing higher. It's a step in the right direction. XLY, clearly indicating risk on. Big move higher, and it makes sense from the structural chart as well. XLF, pointing higher, well above a neutral 50 SMA. So 3 of the big 4 are looking decent. But again, because this is the heaviest weighted component, I'm not quite ready to say, okay, it's massive time or it's massive risk on time, throw everything else out the window, long everything, take out a second mortgage on your home, go long the markets. I can't say it because the XLK is still pointing firmly to the downside, and it is the heaviest weighted component. If this can perk back up and come higher, then yeah, that's definitely edging closer towards more of a risk on look in the market. And wouldn't that be something coming into, I know I'm kind of skipping around here, but going back to the SPY daily time frame, wouldn't that be something on the, I'm all over the place with the words, excuse me. On the retest of this big critical level where the higher low came from, the break and retest, it's also a number of weekly items, right? The high volume node as well, the 61.8. Wouldn't that be something if as we start to turn off of it, all of a sudden, the risk on indication here in our ratio grid starts to turn positive? Just a thought, we're not there yet. Obviously, the XLK is the laggard and the one to continue to watch. What about the risk off sectors? These are the bottom 4, the ones that take up the least real estate on the screen. XLP is sideways. That does strike me as a decent look for risk off being off. Real estate, same thing. Risk off kind of off, going sideways, neutral, maybe even slightly lower there. The energy sector, it's not completely out of the woods because we did experience this massive lift, and now we're just going sideways slightly above an upward sloping 50 SMA. So I'll put a tilde here, and obviously utilities, as we've pointed out, continues to be the red flag. So we're not all the way there yet. So not only is there a thorn in the side with the XLK, but utilities obviously still firmly indicating risk off, and energy also not all the way out of the woods yet. So we're bordering on the edge. There's starting to become some signs of a shift in the ratio grid, and this is something that I would most certainly recommend that you put into your daily analysis. just to get a sense for when and if this market turn is going to come, you probably want to see some things firm up in the XLK and deteriorate down here in the XLU. That is that. Let's continue along and take a look now at the TNX, which of course is the 10-year interest rate. Something that I would say before we even dive into the technicals here is that at 9:10 tomorrow morning, so that's 9 a.m., 9:10 a.m. essentially, Eastern time, New York time, Jerome Powell will be hopping on the mic, and I imagine that the TNX responds in some kind of way. It's been the Fed's sort of mantra to just come out and continuously say it's, we're wholly devoted to taming inflation and getting it under control. I wouldn't be surprised if he just sort of reiterates those things. Obviously, next week we've got CPI and PPI, which should have a big impact on the market in terms of those inflation reads. So do be prepared for that on Tuesday and Wednesday of next week. But Jerome Powell, 9:10 tomorrow morning. One thing that I'm just thinking about here is, remember what we outlined in last week's video. There's two things that the market likes in terms of the TNX. Number one is, let's draw on a number one. That's really ugly. So number one is that the market likes stable rates, things that are just going sideways. And number two, the market likes rates that are going lower. So either stable or lower rates is what the market enjoys in order to move higher. Does this look stable or lower to you? And I would say that the answer has to be no, right? Obviously, it's higher and not stable. It's not going sideways like it was kind of in this area here, in this area here. Obviously, it was lower in this area here. So overall, we're not doing what the market likes. If Jerome Powell comes out at 9:10 tomorrow morning and says the proper sequence of words and the TNX starts to dribble slightly lower, we're falling from a higher place. So lower rates, just based on that takeaway, I would imagine is a good thing for the marketplace. If he says the right sequence of words and the TNX starts to trend higher tomorrow morning before the bell, that's where it's like, okay, concerning, probably not looking for much more upside in our S&P 500. So it's going to be a very delicate balance tomorrow morning. We will, of course, be covering it live on the pre-market live stream, so tune into that if you don't already, and we'll sort of walk you through some takeaways of what Jay Powell is saying at 9:10 tomorrow morning. Anyways, that's the TNX. Let's take a look at the VIX. What's going on with volatility? Certainly making the move underneath this little box, this little daily range that we've been stuck in, making the move underneath the 25 handle, but we're not out of the woods. So although, yes, we did have a trend day to the upside today, we're falling out of the volatility zone. We're not at the 2050 floor, so I wouldn't, chalk it up to, all right, guys, that's it. Selling's over. It's only up from here, right? That's not what this would indicate. There's very easily the possibility that if Jerome Powell does say something terrible tomorrow morning, this comes back in and maybe we're back off to the races in terms of volatility. Just as a reminder that, if the VIX is going to make a capitulation bottom up towards 3840 handle, it probably means that the SPY, if this is VIX 25 currently, if VIX is going to 40, it means SPY is at least 360, right? So pretty nasty move would unfold in the SPY if the VIX were to really get out of control and start heading up towards this sort of area up here on the chart. So just be mindful of that we're not out of the woods yet from a volatility perspective, and we'll just reaffirm that with the VVIX, which of course is the volatility of the volatility index, coming back lower. So I will continue to say, and maybe this is a term that we've now coined here on the channel, that the flood effect is very well in effect. And what that means is that, the VVIX is telling us at these lows that no one is buying SPY puts, no one is buying VIX calls. So if everybody rushes into those two things all at once, it generally creates some sort of spiral effect, flood effect that we're calling it, right? And the floodgates open and the market moves lower and faster than you could have ever imagined. So we're still in a market environment where that is a possibility, and the VVIX is kind of confirming that. Let's take a look now at the SPY daily levels, hourly levels, and point out some structure that you need to be aware of. So here we go. In the SPY, we're still flirting with mostly acceptance above that 390.85, whereas in the XLK, the heaviest weighted component, we spent some time underneath. We'll see a similarity in the Qs in just a moment. But going forward, what are we watching out for? Again, I think that because we're actually above the single prints from last Friday's session, we'll talk about that on the market profile in just a second. As I outlined in the weekly watch this video on Sunday, I think a reasonable expectation is some balance here and really nothing crazy happening. Now, again, we have that wrench in the mix here, Jerome Powell at 9:10 tomorrow morning, but barring anything crazy that comes out of that talk, I think the market might see some digestion and some balance at these lows, overall putting in a bear flag. If we get a move up and over 399.50, that's where a short squeeze might start to unfold, just based on, if we go to the hourly, being above the neckline of the possible double bottom, right? Not only do you attract new money buyers, but you probably squeeze out some shorts who are positioning in here as well as in here for the downdraft underneath 390.85. So that's the importance of that level. And I would be neutral on this market if any higher low pullbacks happen above 394. Why 394? Well, not only was it the single prints, but it was the high of Tuesday as well, and the breakout level from early afternoon, right, on today's session. So 394, any pullbacks that hold that neutral in the market, 399.50 can produce a move higher. And I would only really be bearish in the S&Ps if, bearish in terms of massive follow through to the downside, if we breach 390.85, which once again on the daily time frame is just your critical level here from the break and retest, right? So far so good, holding up as support. And as we pointed out, wouldn't that be something if the ratio grid starts to signal risk on at this critical area of support? I'm not saying it will happen, but just a scenario to keep in the back pocket, if you will. Next up, we're going to take a look at the market internals. If you don't know what this screen is, I've got a video tutorial for you in the top right-hand corner describing what it is, how you can set it up, how it'll help you make better intraday trading decisions. The main takeaway this week, because it is a shortened trading week, we've only got 2 days of data to look at, is I think today was much more bullish than yesterday was bearish. So hopefully that makes sense. On a relative basis, today was more bullish than yesterday was bearish. And we can easily see that in the internals on the sell day, or the sellish, on the bearish digestion day, Tuesday, the volume reads never got to negative 300 million. On today's bullish read, we got above 300 million. Here, we didn't get into trend zone on the sell day, and here we did get into trend zone on the buy day. On the ticks, I would just point out here that we've got very sporadic ticks on the Tuesday session. Notice that there are some pretty significant upper reads as well as lower reads. Obviously, the build was negative in the cumulative, but look at that comparatively to what happened on today's session, right? A little bit of volatility in the morning, but into the afternoon, it was like domination from the buyers, right? No moves even close to that negative zone here. And, relatively similar size cumulative builds. But again, the main takeaway is that today was probably more bullish than yesterday was bearish. If we quickly fire up the, let's go ahead and grab the VWAP and look at our futures here in the bottom right-hand corner, just getting rid of that 9 EMA. But what I want to point out here is that I'm really not seeing any evidence either of this buying activity being purely short squeeze, right? We have a drive higher, pull back to the VWAP, drive higher, some consolidation and congestion right beneath the prior high of day, which is a reasonable place for that to happen. We remain well above the VWAP. Next push, digestion, push, digestion into the close. This was not, just a rally fueled only by short squeeze. Could there be some of that in there? Yeah, there's always a possibility of that. But this buying activity does seem to me to be methodical and possibly new money buyers. Another really good way to look at this is through the lens of market profile. So if you don't know what this is, again, I've got a video tutorial for you in the top right-hand corner. But a couple of key takeaways. Number one is here are the single prints from last Friday, right? This little H period over here. Monday's high, we know that. Look at where the point of control went on today's session. This is the first time that the point of control has actually migrated higher with price instead of lower with price. Over the past downdraft in the market, oops, of course, it's not going to play nicely. Let's wait for it to load. What's going on? What's going on? Where are we? All right, so bear with me. I'm going to let that do its thing, and I'm just going to go auto fit chart, and we're going to go to the current bar. All right, that's a little bit better. So apologies for the glitchiness there. It usually does not act that way. But throughout this period of time, point of control migrating lower, point of control migrating lower, lower, lower. And on today's session, again, here are your single prints from last Friday, the point of control finally migrated higher with price. So actually a decent takeaway from the buyers. The value area also shifted higher as well, right? So that's just the shaded yellow area here, then shifted higher here. So that's takeaway number one, is that point of control and value did migrate higher. Takeaway number two, which is slightly more nuanced, is going back to the type of buyers that we saw and that we were just outlining in the candlestick version of the ES, right? Typically, when we're looking at market profile, a characteristic of short covering is seeing a profile that would build out as a P, right? Early in the session, you get shorts covering, and then you get balance into the close. That was not the case. Instead, we just have a long, drawn-out profile on today's session, which would be an indication of a trend day as opposed to a short covering fueled rally with digestion at the highs. Wasn't the case. You can see that we have a long, thin profile. It's not overly dominated at the top for a P. We've got decent activity here. The volume is spread throughout. And again, the point of control did migrate higher with price. So from that perspective, it actually is a little bit more of a bullish takeaway as opposed to, okay, sellers either remaining firm with just consolidation and digestion here, or thinking of the buyers as being weak because they're only short covering. It's not the case, right? So building some evidence here, and again, this is what I was referring to earlier, for a couple of more bullish data points. That is ultimately going to do it for the SPY. I do think that a reasonable expectation, again, is for some balance in this area. Use your 399.50 and your 394. Any higher lows above 394, balance, expectation is sideways. If we breach 399.50, maybe there's a slight upward move to be had, but please don't misunderstand what I'm saying. Don't overstay your welcome, right? Obviously, daily downtrend can still be in effect as long as we're really underneath 408.25. So I don't want anyone to misunderstand what I'm saying, but there are some bullish data points now that we're kind of getting a little bit of digestion of this move at this area of critical support. That's the S&P 500. I was going to say spiders. Some people call them the spiders. Some people call it the SPY. You can call it whatever you'd like, but we're moving on to the QQQ. Slightly more relative weakness here, noting that we have some acceptance underneath our break and retest level. Of course, that is this area right here. So 296 is a pivot. That's going to be the equivalent of that 394 we just looked at in the SPY. If we're above that and consolidating here, I'd have to be a little bit more neutral. Little bit of a short squeeze can come. I wouldn't even really call it a short squeeze, but some buying activity up and over 301.75. The stronger quote unquote short squeeze where all of these people get hurt is over 306.15. Now, I'm not necessarily convinced that we do that into tomorrow's session or Friday, but just giving you the numbers, right? So overall, expectation is for sideways here. If we breach 296, I would definitely put my bear hat back on and watch for breakdowns underneath 292. Again, the hourly time frame chart might do a good job of explaining some of these levels. There's your neckline, right? That's where the 301.75 is coming from. And you'll notice higher lows above 296 are respecting these highs and balance range from Tuesday. It's negating any selling pressure that happened here. Again, if we fall back down underneath that, put your bear hat on and again, look for breakdowns of 292. You can imagine that there are probably some, there we go, stop losses stacked underneath that level on the chart right there. So that's the cues in a nutshell. Your downside target would be 287.50 if that were to unfold. Next up is IWM Russell 2000 and the small caps. What's going on over here? I would say the break and retest is perhaps the cleanest on the IWM. So there's your break and retest. It was clean over here, and the reattempt for support is clean on this side as well. 178 is the number. So far, rebounding off of it. You're watching 182 like a hawk. Again, the hourly time frame is going to be our friend here. You'll notice that's where we got rejection, gap fill, and then kind of more selling pressure underneath. It was also, if I do something like this, really critical for that reversal in here. So anyways, anything that remains underneath 182, kind of more neutral. Anything above that, look for a little bit of bullish pressure into 185. That's more of a risk on look into the end of the week for the marketplace. And then, of course, anything underneath 178, which is that daily level, so here's the daily chart again, opens up the door for lower, and that's a bearish outcome for your market. Again, just using this as a risk on, risk off indicator, I would say it's currently falling in the neutral category, bouncing off the 178, but also not above its double bottom neckline, which is much higher, around 185. Let's get into the core list of companies, and then we'll send you on your way with those 3 additional trade ideas. So what's going on in Apple? Very simple setup here in Apple. There's 2 days of balance that have taken place, Tuesday and Wednesday today. If we take out the highs around 156.50, look for a rotation into the neckline of that double bottom at 160.25. Here it is on the hourly time frame chart. You'll notice big rejections, right? Here's our consolidation. If we can breach this, opens up the door through this thin structure to the neckline of what would look like a double bottom like that. So 156.50 is your number on the upside for a breakout here. If we remain in this balance, I would say the sellers have the upper hand and you're looking for shorts underneath 154.15, and that's just the 2-day lows. Your target would, of course, be here from the break and retest around 150.85. And based on this chart currently, I would say with the rally into the close here, slight edge to the buyers. Very, very, very slight edge to the buyers just based on the rally to the close. Next up, Netflix. Back to the daily. This one's very, very simple. Here's a daily balance range, multiple days, look below and fail. We did close back inside, so the target is technically the top end of the range, 234. I don't know that I would trade this long here for the rotation to 234. Instead, I'm watching for either further balance or some sort of bullish pressure to be forming underneath it. And if the market starts to see a turnaround, I'm watching for the 234 break to get us to 241.25. I really don't want to get caught up in this range, especially as the market's trying to come into this juncture. Instead, I'd prefer to trade in the direction of the market when everything is playing nicely. So if the break happens, I do want to see the support from the broad market as well. If it's going to roll over, this time the better short is under the 50 SMA and 215 at this point in time for the move into 204.25. But currently, again, based on the look below and fail, I would favor some upside into the end of the week. Next up, we've got Tesla. What's going on in Tessie? Here is your daily balance range. 280 threw me for a loop this morning. I was definitely bearish up against it on the first test, and we did go sideways underneath it, but ultimately closed the daily bar back inside. So no longer is it break, retest, and lower. Now it's starting to look like, although not firmly confirmed, I would wait for a move over 287.50, look below and fail, right? So over time, can we start to target 311.70? Maybe, but again, I would want to see the confirmation up and over 287.50 before potentially getting stuffed on what could look like a break and retest of this flush point instead. So Tesla's kind of in a tricky spot. I would say that this is really just building out a sideways balance. There's not a whole lot of trend that's happening here inside of Tesla. So watching those levels closely. 287.50 is your critical upside. I wouldn't really want to be shorting through this range. Scalps are fine, day trades are fine. I'm not saying don't do that. But for people looking for the larger moves in Tesla, your better short is underneath these two equal lows, which are stacked at 266.50. Next up, we've got Google. What's going on in Google? Big failure of the bear flag, right? So we had mentioned, here you go, we were kind of concerned with the undercut of the low. You can go back and watch the Sunday video. We explicitly described this. The fact that the sellers did not really materialize. Again, we made the excuse. Maybe it's because it's late in the day on a Friday before a long weekend, but sellers couldn't get it done. We couldn't even remain underneath the low end of that flag, the breakdown point at 108.25, and instead we've rallied and closed back inside. So this is firmly, like no doubt about it, a look below and fail. I would be watching this level here at 110.50 like a hawk for the possible breakout to get us back to the 50 SMA through this thin structure right here. And again, I would want the support of the broad market before looking for a trade like this to unfold in Google. So overall, the implications are that the seller's massive failure here, if we can breach this, not, this is not a guarantee, but this is if we take out 110.50, that's where your upside trade can unfold from. Next up, we've got Meta. What's going on in this one? Really more of a boring look inside of Meta. If anything, this has relative weakness. We know that shouldn't come as a surprise because it's part of the XLC. Here's a break, retest, and kind of, just acceptance underneath 160.50. Here it is on the hourly. Looking into this, a majority of the session obviously accepted below, kind of just barely closed right on the back test of 160.50. So if the market starts to roll over again, and this is kind of just a big fake out to the upside, Meta is probably a place that I would look for a short up against this 160.50. So carry this one forward as a relative weakness candidate. If you're not comfortable shorting the back test of 160.50, obviously it's just a breakdown of this daily range underneath the 155.65. So be patient for that setup. Next up is NVIDIA. What's happening here? Sellers could not really get it going underneath. Let me adjust this chart. It's pretty ugly to look at when they get so skewed like this. That's looking better. So here we go. There's the level, right? And maybe that was all for nothing, because if we look at it on the hourly time frame, this is probably better to look at. Let's do this. Apologies, bear with me. There we go. So most of the acceptance was happening underneath that inside bar low, which was at 136.40. And look at where we closed, right? All of a sudden, we take out all of that earlier price action on the day and Tuesday, and we firmly close above. So sellers not really able to make it happen. If it was going to be a weaker chart setup, you would have seen a close down here, setting up the breakdown into the end of week underneath 132.75. Currently, again, unless Jerome Powell comes out and says that the world's ending and inflation is out of control and there's nothing we can do to save it, then yeah, of course we're going to break down here in NVIDIA. But so far, if everything goes status quo, this is actually a step in the right direction. I would watch for a bull flag to form here, and then longs are trying to get back up towards this pivot high in here. 141 is your number. So watch out for NVIDIA long. Shorts who piled in probably disappointed on a close back above 136.40. That's all I've got to say about that one. Here it is on the daily time frame. Technically, we've got a hammer candle taking out the high. Target again, probably somewhere up here. Maybe it's that 141 that we just described, and then the gap fill after that. The risk reward seems to make sense, especially if you're someone looking for this and your stop is kind of underneath the lows in here. So overall, just getting the sense that the sellers don't have it going on inside of NVIDIA. Next up, we've got Microsoft. What's going on here? And that's in the short term. Obviously, in the long term, downtrend in NVIDIA. I'm not trying to deny that, obviously. So Microsoft, what's happening in this one? Really choppy. I wouldn't really look into this one as a clean trade as of right now. Getting a little bit of bounce activity off of this 253.50, but in here, choppy. Don't really want to get involved. Hourly time frame just for a little bit more clarity. Let's take a closer look. So, I mean, you're getting some highs in here, some highs in here. You have resistance there. I just don't like it in this overall range. I'm not seeing anything obvious to do here inside of Microsoft. So because of that, there's no setup to really talk about from this time frame perspective. I'm not saying don't scalp it in there. That's fine as always, right? But from this time frame perspective, I'm not really seeing anything. I would say if this does build out a bear flag to look like this, that starts to become attractive, obviously, on the breakdown of that 250, 350. So time will tell inside of Microsoft. Last but not least is the mini beast. We've got Amazon, again, really more of a sideways look currently. So a balance area is in place. Your upside is over 130.75 and your downside is under 125.25. It's really not, it hasn't done anything impressive. Again, firm balance area in place. If it is going to turn into an hourly double bottom, it's got to breach that 130.75. And if that does happen, maybe it draws in enough buyers to get up towards 136.70. We'll ultimately have to see. Let's check in on the hourly just to get again, a little bit more of a granular picture here. So this is the double bottom that we're talking about, right? Boom, you can see 130.75. We're yet to get into it. So kind of a patience play early on in Amazon. I definitely want to see the confirmation higher low above that 130.75 before pushing it here out of this daily balance area that we've just outlined. If it rolls back over towards the lows, you know, maybe there's something to do at 125.25, but again, you would need the broad market falling out of the sky for that type of trade to unfold, especially after what we've seen on today's session. So that is the core list of companies. I've got 3 quick trade ideas to share with you. First one is on LLY for Eli Lilly and Company. This is in the medical space, so the XLV healthcare. Think about that. Two highs stacked. I guess it's 2-day highs, right? 312.30. If we breach that, you're looking for the 50 SMA and potentially watching for some runners into the highs here around 323.61. The reason that this made the cut, obviously, is because the XLV did put in an impressive reversal on today's session. If it breaks out of that daily balance range up above that 127 that we were discussing, this looks good for the move up and over 312, right? So that's LLY, and you probably don't want to get involved if it just stays sideways down here. Certainly don't want to get involved if it's back down underneath 300. Next up, what do we have? It's going to be PINS, P-I-N-S, Pinterest. This got an upgrade. I can't remember if it was today or it must have been today. That's why I gapped up. But anyways, here's a range on the daily, right? Technically, kind of looking like an inverted head and shoulders. There's a neckline, basically a breakout level around 24. If we breach that to the upside where we headed, probably up towards this gap close area, you'll notice that we have a gap from here to here. So first target probably wants to be the 200 SMA. A breach of these highs, boom, that gets us up towards 25.60. So from 24 up there, about $1.60 for upside. So with options, it's definitely reasonable to be watching out for. And then the gap fill is up at 26. Not interested if it can't get out of its own way and just goes sideways in this overall range. Really needs to break that level for us to take a position here in PINS. Next up, last but not least, is another name in the healthcare space, BMY, BMY. Got the letters backwards there. Bristol Myers Squibb. What's going on here? Certainly big gap down, nasty, right? But it's providing some structure to trade for. Currently, looking at this as a little bit of a cup and handle on the smaller time frame. You could look at it as a sort of V-shaped recovery with a higher low. You could look at it however you want to look at it, but you can't deny the fact that if you were to breach 69.86, maybe we come in and close the gap. So that could easily be a day trade. You can see that, you know, this is well within reason for the range that this thing can typically travel. It's not like we're shooting for the stars with this kind of setup unfolding here. So watching 69.86 to close up towards 71. Not really interested if it takes out the 3-day lows here around 68 even. And of course, this would help the XLV, or it would help if the XLV is breaking out of its daily range as well. That's going to do it for this week's episode of the Midweek Market Update. If you enjoyed the video or learned anything new today, let me know in the comments section or by giving the video a thumbs up. We have gotten the live stream likes to sort of break out, if you will, up and over that 400 mark. Let's see. I don't know if we hit 1,000 likes per video on these things. I have no idea. I don't really keep up with the metric, but if we can get over 2,000 likes, let's say, that we will consider a breakout of the like button. With that being said, I'm going to wrap it up there. I wish you all a green trading week, and I hope to see you in the live stream tomorrow morning.